our first question that came in live. Let's go to Brad. Brad says, Michael, hello. I have been looking at SPACs using, but it is a little expensive. I was thinking of selling a put to getting the stock price close to $10 if assigned. My question is, there's something I am missing. Are there other risks associated with using this technique with an SPAC? Okay. All right. Well, I don't know the specific one, so let's just grab one here. See if we come up with any here in the search. There we go. No. I don't know if they have it in a list here. There's one. SPCX. I'm going to use that one. The second one that came up, Defiance Next Gen, SPAC came up. They're about at the same price. All right. So I'll use SPAK for our example. Okay, so Brad's considering entering a trade on SPAK, but again, due to the volatility and due to, of course, the uncertainty of these kind of positions, what we're looking at here is he says they are too expensive. And so what I'm thinking of, Brad, is you're considering entering this position as possibly a married put, maybe going out to August. On a stock trading at 27, I might use the 30 strike put as a married put combination. I think it was at 20. This one was at 27, right? Yeah, okay. And that's giving me a 12.3% risk. And this is a normal target. Right? It's a little bit, 15% or so in the money. That's a normal target I'd look for a married put. But the risk is double of what I'd normally allow myself to accept for a married put position. Okay, and there's nothing wrong with that if you're still bullish on it. It just means you need more money to move in the direction. Okay. Now, okay, so that's what we're looking at here when we normally look for that target. Now, what Brad said is that instead of doing it this way, he's considering selling a put. Now, if I just sell a put against it to get the stock at a discount, but I want to own the stock, we're talking about a cash secured or naked put position. I may just sell the at the money 27 strike put, get about maybe $1.50 to $1.65. And it's just going to give us the midpoint here. So what am I doing? I'm selling a put option, which gives me the right to buy the shares of stock at a lower price. I could do the 26, or I could even do the 25, get maybe 80 cents or $1 premium. That's very possible. So I'd have a lower cost basis. But if I really want to get into the stock, if I get it here and I get $1.50, my cost basis is only going to be $25.50. And if it's still trading, let's say right at $26.75, I'm going to have some locked in gain that I can then use for a put option if I get put the stock to continue as a married put with protection going forward with much less of a risk. So what would we be doing when we first open the position? I'm going to put it back to 165 just to keep it even, Brad, okay? There we go. So our break even, as I mentioned, is $25.35. That would be our cost basis if we were put the shares of stock at 27. Here I'm just looking at a standard naked put, similar to an in-the-money covered call, similar risk-reward profile to an in-the-money covered call trade. If the stock stays above 27, Brad's put would expire worthless. He'd keep the $1.65 and he could sell another 27 for April or whatever series is next available. It looks like SPAK only has monthly expirations, no weeklies right now. If the stock falls right to 26 or so, 26.50, he gets put the stock. He's forced to buy it at 27, which is kind of what he wanted to do in this position. But again, now he's still got a cost basis of $25.35. And if he wanted to continue as a married put, he could buy a higher strike put, which would give him a better risk. Otherwise, he's looking at a 6.5% return. Now, we looked at the initial married put with a 12.3% risk for August. Okay? And of course, as we know, that's only at August expiration. That's the worst case scenario. If we hold the stock all the way to expiration, we'd receive the maximum risk, assuming we did no income method adjustments and received no dividend payments. In this case, in the next 14 days, we might make a 6.5% return. We're still putting up $2,700 here, not to buy the stock, but to cover the obligation of the naked put position, cash secured naked put. And if the stock's put to us, we have the lower cost basis. What do we miss out when we looked at the married put profit and loss chart in the beginning? What we saw was a bullish strategy, which even though with that high risk, gains money to the upside because we have a 1 delta on the stock, and we probably only had with the 30 put we were looking at, it was probably about 0.65, maybe 0.7 delta there. So as the stock moves up 2 points, we're still gaining about $1.20, $1.30. Here you can't make more than the $1.65. So if SPAC has a run because of its volatility and does go up to, let's say, 29, well, that's not big, but let's say it goes up to 30, it moves up 3 points, you get your 165, but you miss further upside on the position. Whereas if the stock moves up here, 3 points or so to $30, you might see smaller gain on the married put. Actually, it was only $1.50, maybe $1.60 in that case. And then you could still sell your 30 put, but if it really gaps up and goes to 35, you're going to be making more on the married put because you can only make 165 here. On the reverse end, now that would be an $8 gain. I don't know if that's what kind of movements you're expecting in this case, based on the one you're researching, Brad. On the flip side, if this drops down to $8, down to 20, or down to 19, you're in the loss zone of $400, $500, $600, 3 times what you expected to make with a naked put premium. This loss here is including the premium you originally received. That's why your break even's at 25.35. And if we drop the other way, if we drop down here with the married put, we might be at about half of this risk, 7%, 6.5% as well. Okay. So another question comes in this case is that can you do the put against the same put you'd use against the stock against the short put position? Well, you kind of don't want to. Let me explain why. When we saw the married put, we knew it was a bullish position. I have a positive delta and I'm going to make money as the stock goes up and I'm going to have time to do other adjustments. In Brad's situation, he wants to get put the stock, so that tells me his expectation might be that he doesn't hope that the stock's going to fall below this break even, or if it does, not too far, so he can get the stock at a discount. He's really hoping it's trading in here so he gets put the stock, has that lower cost basis, or it could move up in price. So why wouldn't I want to protect this position to the downside here? If going with that August 30 put gave me I wouldn't say low risk at all. I mentioned it's double the risk I take, but that was a 12.3% risk, double what I normally take, especially for 160 days out in time. But why wouldn't I protect this the same way? And it's because you create a completely different position. The structure of selling a put to get into the stock cheaply, while still using the preferred protection I would use against the long stock, the August 30 put, for example, is the calendar put spread, which means, yes, I could get put the stock at a lower price, but at the same time, I have a much higher risk, and it's not to the downside if the stock falls. It's to the upside if the stock moves up in price. Now, again, we're not expecting it to gap up necessarily to 36, 38, or 40, but you have an upper break even now of only 30, 37. That's a 10% move, and a 10% move down at 23.67. But you have 2 ways to lose. Yes, you have a good profit here of $149 at March expiration, less than the 165 max in that case. But again, what is your structure? Am I bullish here? Am I bearish? No, I'm completely neutral. And are these the kind of new type of investments that we would consider neutral positions? Good God, no. I had said that, you know, a move up to 30 would be a 10% move from where it is now at 27. That doesn't seem likely to happen. I'm sorry, that doesn't seem likely to happen. But then again, it's been trading in that range for the past couple of months and was as high as 35. And in the past 2 weeks, this one, it's not all of them, but this one's dropped down. That 12 points we were talking about actually dropped down 10. It went from 35 to 25, almost a 30% decrease as well. Okay. So in that case, this is something that's more volatile. These are newish instruments that are more volatile, not totally new, but they are newish instruments. I can't remember. Greg sent me, the head programmer and CFO of the company, sent me a list, of course, of the total number of new SPACs that came out with with options, excuse me, in the past 20 days, I think, and it was in a ridiculous number, in the hundreds, brand new ones, in the hundreds that we're offering options now. Now, Brad has a follow-up question, and I'm going to have to research this, Brad, because I haven't researched these before. He says, thank you. Are there additional risks with using options with an SPAC? I don't think there's any additional requirements. I think they just really represent the 100 shares of the underlying. Since you can buy the underlying, it just simply represents 100 shares. I don't think there's any other commitments or any other requirements at assignment or expiration. You know, this 100 shares plus cash, or 50 shares, 60 shares, and then some cash. There's nothing like that. As far as I know, there's nothing different than the standard option. The only thing that's more different than regular options trades is probably the extreme volatility of these positions because they're newer. And I don't know if these are exactly like biotechs or not, meaning that we know what a biotech is, right? A biotech, of course, they've got a smaller biotech, Brad. They've got a drug in the pipeline. It's an $8 stock. You see massive implied volatility as they're heading into a phase 2 or phase 3 trial. That biotech passes the phase 2, and the stock goes from $8 up to 23. Huge gains. But of course, if they miss the phase 2, the option goes down to 85 cents. And I'm sorry, the stock goes down to 85 cents, and there's nothing. There's no option volatility. There's no premium left to help manage a position that you're taking a loss on if you bet bullish on it and it failed. I do not know if these are like that. I don't know if these SPACs are, you know, the IPOs they're launching, if the IPOs don't do well, if it suddenly just falls 10, 15, 20%. We saw a 30% move on this one, it looks like, in just the last 2 weeks. So there's some massive volatility there as well. And you said that one would assume that a stock can't or likely won't go below 10. That's why I ask. I don't know if we have enough historical data, and I haven't done enough research on these, honestly, Brad, to answer that question effectively. There's risk in everything. I can say that. It's always good to have protection. I can say that. I can't comment directly on these SPACs because I have not devoted any time to doing further and in-depth research into them. How volatile they are. Is it worth the price of the volatility for a married put or for even other strategies? Is it worth it to try to play the volatility, to get into something such as a directional bull put bear call spread if you're betting bullish or bearish on it? If it's swinging so wildly, does the extra implied volatility and premium help you with those wild moves? I haven't looked at them in depth enough to know that. I couldn't tell one from the other. As you saw, I had to look them up to find a stock symbol. You mentioned FRX, and I saw no, I don't have the chart up there. You mentioned FRX, of course. There we go. And we're currently at 1189, and you can see that this is only a month and a half old, right? This was released right around in January. It looks like January 6th to January 8th, and stagnation. Almost, okay, we can't say doubled in price, went up 80% in price and came right back down to where it was. Now it's still up, okay, we'll call it 20% from where it opened, right about 1050. Okay, not 20%, it's at 1250. So it's up about 15% from where it first opened. But the trend is declining. See, here's what's interesting. It doesn't even have enough history to really give a 12 and 26 MACD line with a convergence. And there's the 20-day moving average doesn't start till here. So it's fairly new and it's hard to gauge. You did have what we call a Bollinger Band breakout. But again, was that driven by something else? Was that driven because this became the new hot thing, not because of any real strength of the security? And another thing I don't know, but I'll look into it and get some more information as best I can, is on this particular ones, are they, I'm sorry, do they have to report things same as other underlying securities? You know, do we have an earnings date? Do we? I guess we don't. I don't know, or there's not enough data there as well. Okay. So in that case, we'd look at that. And I'm sorry, back to the chart. The Bollinger Bands here. This is the SMA. So he says, Frank said change it to the 8 SMA. in that case. That doesn't change it does change the Bollinger Band, so you get more of a line here, but still doesn't change the MACD in that case. All right, so we're going to leave that there for now. Okay, and we're going to move on to our next question. That's the best I can do for you right now, Brad. They're volatile, and that one had a crash. You saw selling the short put could get you in at 27 as well in that case. So we could consider that moving forward, but I'm going to have to do a little bit more look at that as well.